Morning, Stuart. Thanks for joining. If you've just joined, if you could mute, please, that'd be great. Okay, let's get cracking. Morning, everybody. Thanks for joining this week's Pension Playpen session with John Spain, ex-GAD actuary extraordinaire. Has worked in the private and public sector for many, many years. Henry's going to help and co-host, I think. But John, you've got a presentation and a pitch, and you want to do some slides, which is fantastic. So thanks for that in advance. Just a bit of house rules. First of all, we're recording. So everybody happy that being recorded? JQ? Yeah, Bobby, thank you. Everybody's thumbs up. So we're now recording. In usual Playpen fashion, we want interaction. So Henry and I will be looking at the chat, but also if you want to query, question, agree, disagree, challenge John, then please raise a hand and Henry or I will bring you in. But without any further ado, thanks in advance, John, for your time this morning. Over to you for your presentation.
Thank you. Can you see the slide?
We can. Yeah.
Good. First of all, thanks to Henry and Steve for allowing me access. Thanks to everybody who's here for letting me have the opportunity to turn around. You'll see there are 52 slides, and I'm not going to go through every word, I promise. And you will get the PowerPoint file afterwards. About 20 years ago, Andrew Lloyd Webber hosted a program on TV called How Do We Solve a Problem Like Maria? And he solved it. About 10 years ago, I was looking for the same thing, but it was actually about discount rates, and I haven't solved it, and I don't think it is soluble at all. It was only in around 2013 that I realised I was asking the wrong question. So let's go into presentation mode. These are my personal views, obviously. Some people have been prepared to talk to me, some have not. I'd like the UK actuarial profession to agree with me at some point. What I don't understand is why actuaries claim to understand risks if they don't ever disclose the probabilities to DB pension clients and they never take account of reward explicitly. I've got a few main points and I'll have key takeaways afterwards. Why does this matter? Evidence, yeah, it's quite good stuff. The idea that a single number is a result is laughable, except one cries. Is there a long term? How do we approach forecasting? Then I want to look at simple financial contracts with various metrics. And that's it. No actuary, nobody knows the future. We do need assumptions. Today doesn't represent all we know, whatever people say. Prudence is only identifiable from the best estimate, and one of the most important things on that slide. Single numbers cannot capture future complexity.
Okay, John, I'm only seeing the first slide. Is everybody seeing the first slide, Bobby, or are you seeing all of them?
I'm showing 5.
Ah, no, we're still on 1, John. So, Bobby, JQ, can you see slide 1 only?
I'm still on 1. I'm still on slide 1. Yeah.
Yeah. Okay. So, John, I don't know if you need to do page up, page down, and maybe slideshow mode or something like that.
It is in slideshow mode.
It's on. Yeah. Weird. Okay. Press page down, or see if it moves the slides for us. If you press page down or arrow down. Are you sharing the wrong screen, John? Are you sharing a different screen?
Yes, no, I'm sharing the screen I want to share, which is slide 5.
Yeah, I think you're still showing the first one that you clicked to share screen on.
Ah, hang on, that's better. Things started moving then. So go to where, that's it. Right. Okay. So we can now see slide 5 of 52. So it has moved for us now.
UK DB pension scheme funding is really inefficiently controlled. The PPPR Purple Book gives us quite a lot of information. And over time, membership over 15 years dropped from 14 to just under 10. But in 2021, there were still scheme assets of about 1.7 trillion. In 2024, late 2024, we had 1.2 trillion after LDI crisis. So I think this really matters. Very brief history. There were many more DB schemes set up from 1978 because of contracting out. There were very insignificant guarantees back then, and sponsors and trustees liked having a smooth contribution rate, and the assets were also smoothed back then. But then the guarantees became increasingly significant preservation, cash equivalent transfers, and pension increases, post-retirement pension increases. On the other side of it, dividend tax relief was removed in 1997, and then we had the FIS 17 IAS 19 introduced. We had the early 2000s TMT problem with mark-to-market being used, and TPL became all powerful from 2005. That's all we needed.
On slides 5 still. John, can you move it to 6, please?
Well, that's on 6 now.
Showing us 5, I'm afraid. 5 of 52.
Right, Henry, Steve, I'm going to send you the file. And tell you.
I'll present it. I'll present it, and then that might be easy for everybody. So yes, send me the PowerPoint, and I'll present it. So yeah, that'd be great.
It seems to be working when John double clicks it on the left.
Yeah, when you double.
You can see 6.
We can now see 6. Yeah.
And you can see 7.
We'll go to 7. Move the dial one more.
Now you should see 7.
No, we're still on 6.
We're on 7.
We can now see 7. We can now see 7. Yeah. I think if you actually click on the slide, John, on the actual left, then it works. Your page up, page down, or whatever it is, arrows isn't working. So if you click on the slide, and it seems to work. If you click on 8, if you click on 8 now, John, what happens?
Well, I haven't gone there yet. So,
okay, no, I get that, but yeah, okay. So we're now on 7. So let's see if that works.
We're also only seeing it on a sort of overview. We're not seeing it on presentation view. It's only a tiny thing within the whole screen.
Okay, John, email it to me or Henry, and we'll present it. That's fine, because it's good. It's good stuff.
Can you see 7?
We can see 7, yeah, but it's in summary mode, not main mode.
Okay. Sorry about this.
It's all right.
If you were to click slideshow, it might be better.
All right, let's just go back.
I think, John, you're showing your PowerPoint screen and not the presentation screen.
That's because I've gone into email, so I can send Henry and Steve.
Yes, sure. Yeah.
That.
We'll get there soon, folks. Who liked the just before while we do that? Who liked the announcement about the Pensions Commission yesterday? Should we have a few comments on the Pensions Commission? Henry's thumbs down. Thank you, Henry.
Adair Turner was quite interesting those years ago.
Steve and Henry, I've sent it to you.
Okay, let's have a look. We'll see if we can get that.
Maybe the new Pensions Commission will tell us we've got to put even more money in the hands of financial services participants. It's a little bit like the thing pre-Mansion House the other morning.
Could I just say something on that?
Yeah.
Whilst we're waiting, I'm an avid follower of Henry's blog, but I really didn't understand today's main one about the Pension Commission. I think that what's been presented is good.
That's good. It's one of your mates, Jeannie Drake, who's in charge of it. Lord David.
Well, I think you underrate my ability to disagree with my mates.
Yeah.
I do it all the time, Henry. So I don't think that's a valid criticism. Although I do think that Jeannie is a very good choice to undertake it, and I think it addresses the right issues. The clear problem is it's punts reform many years down the road. And that's clearly a problem, but I think that's better than making the wrong choices. And now we've got the slides, so I'll shut up.
Oh, well, I would say, what is the TEO? Have you read it? The TOR?
Yes, indeed, yes. I think
I found it very vague. Yeah?
Oh, well, yes, they were vague the last time.
The Turner one, was it? I found it half-baked. I found it a last-minute idea. It was what the pensions minister called the la-la land of saving in March. Yeah.
Yeah. Well,
how do we kick this part 2 into the long grass? Yeah.
Yeah.
That's what I think. Start with Jeannie, who is interested. Find an academic and a business leader to match the original Hills and Turner, and again give them an impossible task so there is no answer. That's my view.
Yeah.
Henry, we were going to discuss this on August the 5th, but you're stealing all the thunder, and
we'll save it.
Save it, yeah. So
Sorry,
anyway, John, shall we? We're on page 7 now. I'm presenting, John, so we're on page 7.
Go back to 6.
Go back to 6. Yeah, we can go back to 6. Yeah, here we go. Brief UK DB history. Over to you.
Yeah, the point is that we went from short insignificant guarantees with smoothing permitted to significant benefit guarantees, increase for preservation, cash equivalents and pension increases. And on the other side, dividend tax relief was removed. And then we had stringent corporate pension accounting inflicted upon us. So that wasn't great. So if you go on to slide 7, please. And I reckon, the calculations are on there, such as they are, that at least 131 billion was misallocated in the UK towards pensioners. And that is a huge number. Con thinks it's a higher number, but I'm not quite sure how it gets there. So it took a long time for the results through. Number 8, please. And the point is, we've had so many people say stuff, and people say, yeah, and there's been no evidence presented. The financial economic stuff doesn't really help. So it has to be understood that any evidence available has to be interpreted. It's not crystal clear, and experts need to do this. They need to do it in a way that the stakeholders are empowered to understand what is likely to happen. This does not happen. It has to be independent. And groupthink, I think, is one of the big words on that slide. There's too much of it. Next slide, please. And this is my big thing. Single numbers cannot tell you too much of future uncertainties. There was a paper from NYU Stern, and ZDN wrote a very interesting paper in 2012, which was shifting corporate accounting. And Simon Carr wrote a wonderful science paper back in 2004, and both of those are on the website. But people never say what single number they're fully specifying. 200, mean, median, most, percentile, nothing. We need confidence intervals, and a single number doesn't get you there. Actuarial noise is really important. That's the fog of certainty. And lack of liquidity isn't captured by scalars. Next slide, please. We've known about discounting for over 2,000 years. And the thing is, if we actually knew precisely what we were going to get next year, then an initial 100 would give us 103 or 3% was correct. And converting future cash flows to present is not an abstract thing. It's about discount rate inverse of the investment return. Whichever portfolio you have, that is what the discount rate should be. And we've got actuaries, accountants, project managers, scammers. I know I've covered all of them in scammers, haven't I? There is no such thing as a secure financial environment. Certainty, don't have it. Periods much longer. Assets not just in cash. We do not know the future. And we need to worry about liquidity. Slide 11, please. Anyone? Thank you. Not to market. It was one of the deputy government actuaries who came up with this top-line realistic appraisal of current financial situation. I don't believe that mark-to-market is at all realistic, because markets can be illogical. They need to be illogical sometimes so that people can go for profits. And the question is, do we want to let traders dictate long-term assumptions because they're not interested in long-term? So I'm saying that instead of using TM, we can always go to off-market and see what that does for us. 12, please. Is there a long-term? Trevor Longmore challenged me on this some years ago, and I had fallen into the trap, like many other actuaries, and assume that there is one. Well, there are predators out there, so how much confidence can you have over the long term? Issues have to be discussed in depth, but the stakeholders are entitled to follow their own views rather than just say the regulators. And anything that's agreed should be fully documented. I don't think this stuff is really covered in the Statement of Investment Principles or the Statement of Funding Principles for DB schemes. Let's look at equity risk premium. You'll find some financial economists actually saying there's no such thing. There is. Next slide, please. I'm looking at long-term risk premium over rolling periods of 15 years. I'm looking at the difference between the mean return on UK equities and the mean return of long UK gilts, conventional. The equity return is not just capital, it's not just income, it's also true for bonds. So we can look at how the contribution of capital and income varied over time, and we look at long-term equity risk premium, assuming that capital growth would have been different to what we saw. And we can also look at the likelihood of equity risk premium. Next slide, please. So over 1962 to 2024, you'll see that the average income for capital is the blue line, and that was as high as 77 and as low as 14.5%. It averaged 56 and had a standard deviation of 15. Now, those numbers aren't nice and steady. They vary all over the place. But the real thing is that the capital return component is generally quite a lot higher than that for income. Next slide, please. If you look at the overall period of 15s, that's overall of periods of 15 years between 1962 and 2024. The average return on equities was 10.95%, of which nearly just over half came from capital. Equity was just over 6. If we had only achieved 50% of the capital growth that we saw, then the equity return would have been reduced by 2.8, and the risk premium would have fallen from 4.8 to 2. The return components matter. Next slide, please.
Henry, you had your hand up. Did you want to ask a question, Henry, or not? You're on mute, Henry.
I'd prefer questions at the end, please.
Any questions at the end? Okay.
So if you look at, this is over 15 years, between 62 and 2024, if the capital growth had been the same as we've seen, we're talking about the grey figures, 2.7 average return. However, if we only have 50% growth, then the average return would have been minus 0.4%. The capital growth makes a huge difference. Next slide, please. Now, I have to say that these were used over 1952 instead of 1962 to 2024, and therefore they actually overstate their probabilities, because between 1952 and 62, the equity returns were quite a lot higher than later on. And so these, if you look at the last column called the blend, starting years 1952 through 2009, so the last 15 years period is up to 2024. On average, we would expect 3.8, but a large deviation of 5.9. The probability of getting at least 2% as an equity risk premium is 61.6%. That's pretty nice. 3% is a bit adventurous, I think, but equity risk premium is not a fiction. It exists, unless you're in the wrong equity, of course. Slide 18, please. There was a sessional paper about using market values for long-term valuations of DB pension schemes at Stapley on 25th October. And Andrew Smith used this wonderful expression, fudge, judge and bodge. Or we can just see what did the other actuaries do, but we don't know what they really did. We need to be more robust, we need to have strategy rather than tactics, so long as we actually believe and have reason to believe, evidence, that we have enough time. The off-market is the actuary's tool for soaking up volatility. Next slide, please. If we knew it, we would know exactly what to do for the future, but we do not know it, so we need assumptions. We don't know when things will change, when, which way, how far, how long. There is no such as a free lunch over time. But you can have different restraints. You can't simultaneous aim long and short with the same money, or you have to pay an insurance premium. Actuaries used to be taught that broadly right is much better than precisely wrong. There's been a huge concentration on risk without recognizing the reward which is being sought. That is the reason why risks are taken. Prudence is only available from past testing. I've said this before, but imagine an actuary thinking, well, I could use 2 or I could use 5. 2 definitely sounds more prudent than 5, but if the true number should be 1, then neither are prudent, 5% even less so. Next slide, please. So, if I want to talk about long term, how am I going to get the returns? They need to be consistent with the returns and not just accounting numbers. The Valuation Working Party that I just mentioned met on 25th October 1999, and that was about if we switch to market value of assets, how do we sort out the liabilities, the value of the future cash flows. And the valuation rates of interest Working Party followed on, but was very peremptorily closed down. A couple of us think it was because we were getting into a place which might not have been thought really nice. I was privileged to be a member of both. And the second one agreed that something we call the multiple approach had some potential. They did not agree that it was definitely the right thing, but it's something I took away with me after we were closed down. Slide 21, please. So what I'm looking at is over 15 years, if I look at the multiple average over the 15 years, what is the ratio of that to the initial yield? And the early period from 1952 up to 1985 shows that 2.99, the blue figures in the top left thing, was a lot higher for equities than for the later period from 1985, which is 2.08. The differences between the numbers for gilts aren't that large. But I thought that these numbers are sufficiently stable for me to look at them, which is what I've done. Next slide, please. So now I'm going to invent a new company, a financial company, which is going to do something in a mark-to-market world, setting up a new business, best estimates without formal guarantees, bearing in mind that guarantee costs are rarely understood by or acceptable to consumers. We have two single premium contracts, one chance to get their pricing right, and we won't always. We've either got a term annuity, 1,000 a year in arrears of 15 years of Corvette Inc. Funny that. And I've got a pure endowment of 10 grand payable in 50 years of Corvette Cap. The payments can be either fixed or fully inflation linked, and I've used RPI because it's got a much longer record. And I'm completely ignoring demographics, options, profits, tax, expenses. And the point is, if we can't do the simple stuff, why should we think we can do the complicated? So how much do we really need to fund the basic cash flows? The point is that for this company and for a DB pension scheme, the liabilities are essentially future cash flows. Next slide, please. So I've got 6, there should be 8 different financials, not 6, because I've got 3 different kinds of investment. I've got 3 returns, 3 yields, and 2 inflation rates. So it's 8, not 6. I've modelled annually from the end 1953 to the end of 24, and then I've gone into 2 periods up to excluding 1985 and later including 1984 onwards. Obviously, my index links were only available for the later period, and I'm using something I've called blend. Previous iterations, I had different things, and they're still there on the website. Next slide, please. So I thought from earlier work the non-correlated results should be similar, but I don't actually know that for this. And I've got the blend being defined as a probability of taking a value from the early 20% and taking a value from the later distribution 80%. So it's very much geared to nearer term returns and yields, but we're allowing the chance that we'll revert to something more interesting. 1,000 scenarios, and I find again that normal and logmore don't really work that well, and the random numbers used are typical of now. When I originally submitted something to DWP in 2017, I was using end 2014 numbers. Things have changed a bit. Next slide, please. You'll see that the average early return from 93 to 84 on equities is quite a lot higher than from 1985 to 2024. Less so for long conventional bonds. If we go to the next slide, we find that equity returns have a huge standard deviation for the earlier period compared to the later period, over twice as much, with again non-conventional bids gilts being of a similar order. Next slide, please. I'm assuming that you use gilt yields as a mark-to-market approach. And for fixed contracts, we use conventional gilts. For linked contracts, we use long index-linked gilts. And this ignores the intended investment policy, unlike the off-market position, which may be simplistic, but I think it's good enough. The off-market allows one to look at the intended investment policy. And for equities, I'm multiplying the initial yield by 2.52. For conventional gilts, I'm using 0.88. And for index-linked gilts, I'm using yield plus expected RPI plus 1%, which is where Con and I got to on ukrpi.com. Next slide, please. So here are some links, but the things I want to know about, will we actually have 10,000 in real terms at the end of the cash contract, or 0 for the annuity contract, or will it be somewhere away? How successful will either pricing approach be? How likely, and this is a bit different, is it that the annuity fund will be exhausted early with the cash contract? There is only one benefits cash flow at the end. How excessively cautious was the initial price? And finally, how should we vary the initial discount rate to get the right number? So what I'm doing is I'm pushing through the estimates, then at the same time I'm solving to see what they should have been and recording all of that. Next slide, please. So look at the fund example for linked cash, invested in conventional gilts, either in mark-to-market or off-market, and we're still using the blend. Everything is using the blend. At the end, the deflated fund value will be 11,200, or it'll be 23,500 for the off-market, which is really not very good. And one of the things I should point out, that using fixed conventional gilts to match an RPI set of benefits is probably not a good idea. And both of them came from an opening fund of 8,444 or 18,607. Well, clearly they're both too high. So if I want to get the end fund value being 10,000 in deflated terms, the new opening fund has to be just under 10,000 at 9,666, and both of them have to start there because they're going to have the same cash flows in terms of returns. And the required discount rate adjustment is because the first one, mark to market, was too low, we have to reduce it so that we get a higher cash discounted value. For the off market, the red figure, we need to increase the discount rate by 0.55% to bring that down to 9,666. Those numbers, minus 0.31 and plus 0.55, don't seem very good, big, but some of the others are really quite huge. Slide 30, please. Here is just a screen grab from this particular set, and you can see the 844 is blue, and you can see that on the right, on a grey background, you can see what you can change, capital or income, whether it's market value or discount value, whether you have inflation or not, or you're looking at the beginning of the process or the end, what kind of assets you're using, and what statistic do you want to pull out. This was the average, or the mean. Next slide, please. Now, at the top slide, you will see that the contract we were talking about, 8444, is the same for all kinds of investment, because we're assuming that we only look at fixed, in this case, index-linked gilts. But it's linked to inflation. So, and you see the same thing across. Whereas if you see the lower section, you see the same 18607, and you'll find that this contract would have been best matched by something half invested in index linked and half in equities. The 1 and the 6 always just show the extremes, and not necessarily the way you want them. Again, if you look at the third column, blend income RPI, that's index linked income, 18,000, because you're investing in something which is basically not very likely to give you the returns. And again, index linked and equity half and half would have given you the best results. Next slide, please. How often will we have enough at the end? And I've got 3 situations. Either we don't have enough, we have acceptable, which the surplus at the end is not too high, I've called that okay, and wasteful, which you've got too much, more than 1,000. If you reduce 1,000 to 500, say, then more waste will be seen than otherwise. Now, for the same contract, example, linked cash in fixed gilts, you find that both of them are pretty bad. They'll be too low, they'll only be okay in about 5%, and they will be wasteful in over 40% for both. Next slide, please. And again, this is just showing that you can actually look at this online on the website. Next slide, please. And here we have the success chance for mark to market. The acceptable numbers in the top block are really very small. The failure are quite high, 99.6%, 100. Yeah, right. Well, index linked, 100% is not going to be very good for matching the second column of non-indexed capital. And wasteful, we've got some high numbers in there as well. Next slide, please. And this is the off-market approach. And in fact, the off-market didn't do very well at all. In fact, it was wasteful all the way down for the income contracts, and not as bad for the cash contracts. Next slide. I've only shown this slide, showing the difference between slides 3 and 4, to show that there is no pattern between the two, just all over the place. Slide 37, please. That's not quite the same, because annuity funds can become insufficient before the end of the contract. And we find that if you have a linked annuity invested in fix, at the end of 15 years, the mark-to-market will be 51.9% insufficient, and we saw that on the previous slide actually, 12.4%, but we're okay at 5 years, which is nice. And if we go to the next slide, please. Again, there's just a screen grab for this thing. If we go to the third slide, next slide, please. And here are the annuity failures for 5, 10, and 15. If you look at mark-to-market, equity will fail 0.2% of the time at 5 years. But why one was investing in equities for this, I do not know. Off-market is actually pretty good, supremely good. Can we move on, please? I want to compare what the required initial premium is compared to what we actually started with as a ratio. And again, I'm using linked cash, fixed investment, And the 4, we guessed 8,444 and 18,607, and the accurate was 9,666. Has to be the same. The caution ratio, just using the two numbers above as 0.87 and 1.93, but I'm now actually calculating it within the runs, and it should be 1.12, 2.35. So the off market number was way too high. This explains why we had some 100% just before. Next slide, please. Again, this is just a screen grab. Next slide, please. Oh, that's for the other.
Sure, that JP Morgan one was when 30 said to me at the time.
I'm not getting that at all.
Keep going, John, that's fine.
Okay, let me move on to 43. And here are the numbers. 1.12 we saw on an earlier slide, and 2.35 we saw on an earlier slide. And 2.35 in the off-market section is the highest for the index-linked cash. 0.35 is the lowest, and that's for index-linked, which again, you wouldn't really expect that to work so well. Next slide, please. And this is the final metric I'm looking at. How far was the original discount rate used from where we should have been? Same contract. We initially guessed 1.46 or 0.6. The accurate is 1.08. And they must be the same because you've only got one benefits outgo at the end, same returns, and the adjustment is minus 0.37 or 0.48. And if we go on to the next one, again, this is just a screen grab. The next slide, please. And so is this. Next slide, please. Now, here I'm looking at numeric values, and then minus 0.31 and 0.55 at the top of the mark-to-market mean and the top of off-market mean of figures we saw before. And the red shaded are ones where they have to be reduced, and the unshaded are the ones where they have to be increased. If you take the absolute difference, or minus 0.31, and the absolute difference of 0.55, which happens to be the same thing, and look at the difference, it's 0.24. So both of them were actually almost as close to where we should have been as the other. Next slide, please. But it's not as simple as that, because if you have 100 adjustments, say 50 are minus 2 and 50 are plus 2, then the average will be 0. Fantastic, but it's not persuasive because none of them were anywhere near 0. Being too far under is as bad as too far over. And you see that for the same example, equities, capital, inflation linked, the numeric mean is 3.42 and numeric off mean is 0.47. The absolute MTM is 5.19 and numeric was 5.71. I rather think I've gone wrong on that slide. I think they should all be absolute. But the point is, numeric values alone, because they're not looking at the spread properly, don't really do it. They understate the errors. But luckily, it's not the sole metric. Slide 49, please. And here are the actual adjustments that we would need if you just look at the absolute numbers. Slide 50, please. We're back to surplus refunds, which will allegedly drive UK growth. We had this between 1987 to 2004, and GAD carried 84 detailed inquiries for inland revenue, and we found that actuaries didn't all understand what they were supposed to be doing. I think this will happen again. Challenge 2 of the ACA's 2025 policy paper suggested that the total remaining assets after a surplus refund, including any covenant value, would need a high degree of confidence about the full existing benefits being paid out. And that's essentially a probability which requires a stochastic process. If I was still a trustee, I would be demanding robust stochastic evidence at the sponsor's expense. And last but one slide, please. The discount process, we've had it for a very long time, but it's not the only thing in town. We should be being more imaginative, and I think it hides far more than it reveals. Simple and simplistic, anyone can use them and does, and everybody has danger. For long-term projects with specified intended incomes, we should stop using discount rates alone, because cash flows are the key elements, and otherwise you can't identify liquidity at any point in the future. Final slide, please. Key takeaways. Evidence. One point doesn't represent all we know. We need to think about reward. That is why we're taking risks. Scalers are useless for many future uncertainties. We had 131 billion or more misallocated in the UK over 15 years. Scheme assets fell by nearly a third in 2021 to 2024, and that was LDI basically. And my simple question is, if we can't do simple stuff, can we really state that we can do complex stuff? I don't think so. And the irony there is that I'm saying we should be using complex stuff to get to simple stuff. That's okay. I have run out of slides.
Okay. John, thanks for that. Henry, you did have a hand raised, and if anybody else has any questions, please raise a hand and challenge John.
I put my hand up when I lost my way in the presentation, and actually over the next 40 slides, I don't think I would have had my hand down, so I'm glad you stopped me from asking the question. But I'm sure there are people on this web who understood what you said, and I think I got the ending right, where the getting there bit was a bit hard for a simple soul like me. John, do you, I mean, it's not really for me to comment because I'm just not up to it, but does anyone else want to ask any questions? Martin, now you've been extremely vocal in the chat box. I look forward to hearing more from you.
Yes. I have a lot of trouble understanding just what the points are that are being made here. And the question is how to go about it in such a way that I have a clue. Now, I ought to have a clue because I have been a pensions actuary and I'm very interested in investment. But it seems to me that the place I would start is the thing I put in the chat, which is a link to an essay by Warren Buffett that he wrote in 1975, basically saying actuaries are good at doing sums, but they're no good at making assumptions because they can't recognize the fact the real world changes like crazy. Now, I have a feeling of what John's saying here is not inconsistent with that, but somehow I need it to be made much more simple what's going on. And each of the slides needs vast amounts of context to say what it's all about, because it's as if we are close to it and we've been presented something as if we were already experts, and I think we've almost all not quite got a clue what each slide means. So I'm dead interested in what John's got to say. I have always been, but I've never quite managed to work it out. So sorry about that.
I'm saying that anything which ends up with one value is suspicious. And we've got to be able to do better.
Yeah, but you could say that in one sentence. It's very tricky to know quite what.
I can say that in one sentence, but I won't actually have anything to back it up without looking at numbers.
That is true, John. Okay, JQ, you got your hand raised. Did you understand? You probably understood all of that, JQ, because you're a mustard actuary.
I wouldn't say that, but no, I did understand it. Yeah, it's I mean, look, there's a few obvious comments and thoughts. Mark to model, mark to market, both are right until they're wrong. Okay, so it's and the challenge is no more complex than sometimes in mark to market. It's momentum buying, it's trading, it's whatever. A mark to model, the challenge with that is when the model diverges from the market too much, you end up with what we had in the early 90s, some crazy stuff at MFR and the like. So it's a non-trivial thing to say one model's better than the other. I certainly agree that having worked in the pensions world and the insurance world, that there is historically a weakness in the there seems to be a disconnect between the discount rates and the assets. I mean, so I've always believed that there should be an asset-derived discount rate, or AD for short, because it is obvious. And the other challenge with discount with present values is when you go 30 years out, it's a nonsense. As in the value when you discount something 30 years out, it approximates to zero fairly quickly at any decent discount rates, and that's a non-trivial issue. I would say though that in particular, I think from what I've seen, the actuaries on the insurance side are much more disciplined at this than those in the pensions world, because they've got capital rather than covenant. I'm not saying they're better. They're better across everything. They're better at that piece, I think, in particular.
That's such an interesting observation, John. Can you just say it one more time so I can properly understand what you just said? Because I think it helps me understand what John says.
In terms of capital, so capital versus covenant. The covenant is a non-finite guarantee. It's an infinite guarantee, the covenant. And clearly in a capital world, you've got finite amount. In an insurance world, you've got finite amount of capital. And as a consequence, you can go to the market, you can raise more if things happen. I think that naturally creates an approach and a discipline, not for every scheme. I'm not criticising the pensions world across the board, but I do think from what I've seen, it does create a different mindset and approach. And it's all to do with the matching assets piece, your fundamental spread, and the default downgrade assumptions and so on, which are pretty much, they're tried and tested. We've run the Solvency UK numbers using banking models, Moody's stuff, and migration tables, and it's amazing. They come out pretty damn close. If you use banking techniques and insurance techniques together, actually you get a pretty same but different answers. Does that make any more sense? I don't know if it made any more sense. I apologise if it didn't.
It puts me in the picture. Thank you very much for helping me up the ladder. Bobby Ridaway, he's got his, and although he always looks a bit of a booby to me, he's just got an unbelievable amount of brains. I
used to work in insurance, and what's quite often missed is that the solvency figures for insurance, they're just about the surplus and the buffer capital. Insurers, they invest in, certainly in the pensions world, or annuities in terms of cash flows, they invest in assets that produce those cash flows. Their prudence then is around how much they have to reinvest if the cash flows are slightly too short, or if there's a default, if it's not a gilt investment. They don't play around with the cash flows. They invest and match those cash flows, and all their uncertainty then is in the level of surplus on the solvency level. So it's a completely different game. And what the actuaries were arguing, which I didn't agree with at the time when they went to market because of this, is they were arguing that pensions should do the same. They should get an asset, and they argued that the asset the pension schemes should invest in first was an annuity. And the overall implication of that, and the main reason why pensions don't value like insurers, is because it would have cost a lot more money. Pension defined benefit schemes would never have been set up if you had to match your cash flows with gilts and with a very certain corporate bond. So we can talk about all the valuation of all the things, but the elephant in the room has always been between insurance and pensions. The cost of investing like an insurer is not the cost of investing like a pension scheme. Pension schemes try to hit the targets of the cost of the pensions. Insurers, they invest all the money they need to meet the cost of their annuities, and then they do all this complicated analysis on the surplus they have, which is generally a lot more money than they need to pay the annuities, when in fact the cost of not paying the annuities, given the assets they're invested in, is quite low, the probability of not hitting them.
Thank you so much for that, Bobby, and thank you so much, John. We wouldn't have had that conversation without being for John, and thank you very much for elucidating me. Is that the right word? Probably not. Martin, you've got another question.
Yes, one of the things that worries me a lot, and I'm a member of the actuarial profession, is that we don't do enough deep thinking about where investment returns really come from and what would drive the uncertainty in future investment returns. So for me, I would say everything really comes from equity profits, because everything else is borrowing from other people. And harking back to the session we had with Andrew Smithers, he basically was saying what counts is, first of all, the internal rate of return post-tax that companies get. And what secondly counts is the price at which you buy in. And part of his story was saying that there are times if you buy in when you're going to do terribly badly, and there are times when you're going to do terribly well. So it's not impossible to judge when the market's extremely high or extremely low. Everything else is a bit hard. But it seems to me we just don't face up to the fact that there is this huge uncertainty out there. That was it.
Thank you for that, Martin. Bobby, you got your hand up again, and yeah. I delight in your comments, so go ahead.
Yeah, I think UK pensions is the only industry that tries to take advance credit for equity risk. I don't think you can go around the world and price another product which tries to take advantage of equity risk, which doesn't have alongside it past performance is not necessarily a guide to future performance, and your capital is at risk if you invest in this product.
I think it's a good point to perhaps close the discussion, unless anyone wants to say anything to wrap up. I give John that opportunity because he gave us the excellent talk, or at least the complicated talk, which was, I think, to most of us, but excellent. But to me, a bit mystified.
I would really like it if the questions could be forwarded to me, and I'll try and answer them as best I can. And you know, have the slides, please issue them to whoever signed up.
Yeah, if anybody wants the slides, then please contact me or Henry, and we'll send you the slides. And if you've got any further questions, we can hook you up with John.
The blog will, of course, contain my slides, John, as will the video of this excellent event. So anyone who wants to tease it out can do so for a second time, or anyone who's coming to it for a first time can really give it a go. Thank you very much indeed, John. Thank you, Steve, for doing the slides. This is fantastic. Thank you, Martin and Bobby, for making a lot of extra sense on what was all there. And of course, John Quinlivan too, our three expert actuaries on the day. And I think I am right in saying you all are free actuaries as well as John, yeah?
I'm no longer a member of the profession.
I just a non-professional activity. Actually, that's the new one on me. And then there is, of course, lurking in the background there, Lord Brixton, who may have gone away actually after I was so rude to him early on. But anyway, if you're still there, Lord Brixton, please forgive me for being rude about the La La Land events, which we're about to witness, the 2 years of whatever of discussion about saving. Good. Okay.
Well done, Henry. So
right.
big thanks to John. Virtual claps and actual claps to John. Thanks for that. Please contact us about the slides, and the video will be up later on. We have next week Nest. So if anybody's got interest in Nest, good, bad, or ugly, then join us next week to talk to
It's not
Nest.
just Nest. It's not just. It's Paul Todd.
It's Paul Todd of Nest. Oh, well, there we go.
The man who is changing the face of DC pensions.
Perfect.
Now,
well, there you go.
I have to say this is something that I asked him personally to do, because I bought him lunch actually. He's still not bought me lunch back, but I do think that Nest has got something to say, which is very real and very different. So please tell your friends and come yourself.
Yeah, exactly. And please join us again the following week on the 5th for our Pensions Commission, chaired by Lord Bryn, or Lord Davies of Brixton, and Henry Tapper. So there we go.
No. That will be a fight. Just Lord.
I'll talk to him. I'll talk to him. Yeah, I'll see if he wants.
You have not made that gig yet.
I know. I'm just being a bit cheeky, but there we go. Anyway, there we go.
Right.
But everybody, thanks for your input today. Thanks for listening. Hope you enjoyed the presentation, and thank you especially to John. Thanks for that, John. Have a great day, and thanks for joining today. And enjoy the rest of your day and week. Thanks very much.
Thank you very much.
Thank you.
Cheers.
Have a
Bye. Cheers, John. Bye.
Cheers.